global rating agency Moody's has given Union Budget 2013 a thumbs up. Moody's is of the view that Union Budget 2013 is constructive, it is positive, and in the near term it will only kickstart growth for Indian economy. Let's understand that analysis, and to discuss Moody's outlook on Union Budget 2013, we are now joined by Atsi Sheth. She is Vice President, Sovereign Risk Group with Moody's. She joins us from New York. Atsi, good morning. Thank you for joining us. What did you make of India's budget, and how does this impact the overall rating picture?
The budget was in line with our expectations, which are that a single budget is merely the statement of the government's financial accounts, and this budget certainly showed a modest fiscal consolidation. That the budget deficit went from 5.7 to 5.2 this year, and then next year is expected to go to 4.8. This modest fiscal consolidation, frankly, is what we had expected. We think it's quite realistic. So it really is in keeping with the stable outlook on the Baa3 rating that we have on the Indian sovereign.
Atsi, hi, morning. You say fiscal consolidation is realistic, but we are also in the year before elections, and in past we've seen slippages. Do you think politics could be a risk to the 4.8% fiscal deficit target?
Certainly, I think not just politics, but growth is also a risk to this target, as is the divestment assumption and the subsidy assumption. So there are a number of risks to the target, but the reason we think the budget is realistic is that there is a cushion built up in terms of capital expenditures and plan expenditures. And what we've seen in the past is that when revenues don't meet the government's target, or when the subsidy bill goes above the government's target, as it has happened in the past, what the government does is constrains its own capital expenditures, and that's what it did over the last year, and that's what we expect it might do over the next year if the revenues don't perform as expected.
But see, if you believe that the budget was a responsible budget, do you believe that there is a strong case for monetary easing, and do you expect sufficient easing to revive investment cycle?
I think a commitment to fiscal consolidation and implementation of that commitment was one necessary consideration in paving the way for monetary easing, but it wasn't a sufficient condition. I think monetary easing depends on, one, fiscal consolidation and the RBI's belief that it will continue, as you say, in an election year when growth is not, performing as well. So that's, the RBI's, whether the RBI buys this or not. And the other factors that will affect monetary easing are, of course, inflation dynamics and the current account dynamics. And what we've seen is that while core inflation, non-food, non-fuel inflation is indeed coming off its highs, commodity price inflation is still a risk. So that's one more thing for the RBI to consider. And the current account definitely is at a very wide level. It's at a record high. So that's the other thing that the RBI would consider. And I think the drivers in both these cases perhaps don't support a strong case for monetary easing.
Right, Atsi, the finance minister was clearly able to keep fiscal deficit under check for FY13 at 5.2, but that was largely due to planned expenditure cuts. Won't that hurt the industry?
It's interesting because on the one hand, there's a belief that private sector expenditure on investment is much more efficient and cost-effective than, say, government expenditure on investment. If that is the case, then really what you want to see is not government increasing its expenditure on capital projects, but you want to see the government controlling its expenditure in whatever way possible so that more monies are freed up for the private sector to conduct this. So that's the flip side of looking at it. From our perspective, what we did see is that while the government curtailed plan expenditure, it did increase its subsidy expenditure quite a bit. So for us, that really was the suboptimal element because what that did was, perhaps fueled inflation in the commodities that were subsidized, and it didn't control the budget as much as it could have if subsidies had been kept in check. So I would say it's subsidy expenditure control or lack thereof that is more of a concern for us than plan expenditure. We agree that in a perfect world, had the government enough resources, it would invest in capital projects, but the government does not. So they have to cut down somewhere, and this is where they chose to cut down.
Are you convinced about the FY14 budget numbers, or you think the assumption of 13.4% is little too optimistic, especially in the light of the GDP number what we've reported for the quarter gone by, which was a poor 4.5%?
Actually, we do think it's optimistic. We think the growth assumptions are optimistic, and the tax revenue assumptions that are based on these growth assumptions are therefore also optimistic. So we expect that will pose a risk to meeting the 4.8% number. But we also believe that the government has in the past curtailed expenditures, plan expenditures particularly, to meet its target, and that will be the likely way that it meets this target, if it does indeed meet it.
So are you convinced that subsidy spending can be curtailed by 10%, and are you penning down any slippages?
In the past 7 years, subsidies have actually come in at much higher levels than the government had budgeted in its initial February budget. So we expect that this will likely be the case this year as well. There's two things that could lead to subsidy expenditure actually being curtailed. One is if domestic policy actually cuts down on the items that are being subsidized or the extent of the subsidy. This is what we've seen happen in the case of fuel subsidies, for instance, petrol, diesel, etc. So if that was extended, then that is one way that the subsidy expenditure could be controlled. However, we're not our base case is not that this is the way the expenditures would be controlled. The other way that they could be controlled would be by commodity prices themselves. That's fuel prices, food prices, and fertilizer prices coming out less than what was anticipated or being less than what we currently anticipated. Again, we don't think that there'll be a substantial decline in either food, fertilizer, or oil prices in the near term. So we do think that the subsidy expenditure will exceed the target.
That's rupees 40,000 coming in from the disinvestment side. In FY13, the telecom revenues fell substantially short of the initial projection. Do you think both the numbers are slightly optimistic?
You know, if you look at the divestment targets versus actuals in the recent past, they have always fallen short. So if one bases one's assumptions on what's happened in the past, which is a reasonable way to think about the future, certainly you could expect the divestment target will fall short or it will not be met. On the other hand, one of the things that the ministry has done over the past 6 months is exhibit a fairly strong commitment to meeting, its budget deficit target, and it's implemented this commitment. It cut down expenditures even at the expense of growth. So if the government was keen to exhibit commitment over this year, which is important not just for market sentiment, but it's important even in actual real fiscal terms to bring down inflation, etc. This is one area where implementation matters. They could implement. They could just move ahead in a way that they haven't been able to in the past and meet these targets. And that would certainly be something that's not beyond the pale of imagination that could happen.
That's good chatting with you. Appreciate you taking the time out and joining us on the show.